The U.S. housing market has always been a complex and ever-evolving ecosystem, shaped by interest rates, demographic shifts, technological innovation, and global economic forces. As we step into the final quarter of 2025, the market is once again sending mixed signals, signs of renewed opportunity in some areas, while others remain clouded by uncertainty. Today, I want to take you through three of the most significant developments shaping real estate in America right now: the notable decline in 30-year mortgage rates, the surprising rebound of San Francisco's housing market, and the continued dominance of Miami's ultra-luxury sector. Let's start with the big picture. For nearly 2 years, elevated mortgage rates have acted as the single largest barrier for both homebuyers and sellers. Many first-time buyers were simply priced out, while existing homeowners chose to stay put, reluctant to give up their low-rate mortgages for new loans at 7% or higher. That stagnation has now started to shift, with the 30-year fixed rate easing down to roughly 6.56%. We are witnessing a psychological turning point. It may not sound like a dramatic drop on paper, but in practice, it's enough to unlock demand that has been pinned up since the peak of 2022. For many would-be buyers, affordability is finally edging back into the realm of possibility. And for investors, this could mark the beginning of a more sustainable cycle, one that balances price growth with financing that isn't prohibitively expensive. But beyond interest rates, the story of U.S. real estate in 2025 is also a story of regional contrasts. Nowhere is that more evident than in California's Bay Area. For much of the past decade, San Francisco has been labeled a fallen giant in real estate, a city battling high costs, outmigration, and commercial vacancies. Yet today, the data is pointing to a different narrative. While the broader Bay Area cools, San Francisco itself is heating up again. Transactions have increased by about 5% year over year, even as home prices dipped slightly by 1%. The driving force? The rise of artificial intelligence. With tech firms doubling down on AI research and startups flooding the city, a new wave of talent is moving in. That influx is breathing life back into both the ownership and rental markets, sparking cautious optimism about San Francisco's future. And then there's Miami, a market that continues to defy traditional economic logic. If San Francisco's rebound reflects the power of technology, Miami's resilience reflects the influence of global wealth. More than half of all transactions for homes priced above $1 million are now conducted in all cash. At the very top end, properties over $10 million, the figure is closer to 60%. While overall sales velocity has slowed, Miami's luxury market remains a magnet for the ultra-rich, from international investors to celebrities seeking beachfront estates. In other words, Miami isn't just a housing market. It's an asset class of its own, largely immune to the financing pressures felt elsewhere. So, what do these three developments tell us? They remind us that real estate is never a one-size-fits-all story. It's a patchwork of markets, each influenced by its own unique drivers. Mortgage rates may dictate national affordability, but technology hubs and luxury enclaves are playing by their own rules. In this video, we'll break down each of these stories in detail, analyze their implications, and explore what they mean for buyers, sellers, and investors in the months ahead. Part 1. The 30-year mortgage rate decline, what it means for buyers and the market. The most important factor influencing the U.S. housing market in 2025 is not inventory, not even pricing trends, it's interest rates. Specifically, the 30-year fixed-rate mortgage, the benchmark product that defines the affordability of American homeownership. Over the past several years, mortgage rates have swung dramatically, first fueled by pandemic-era lows, and then propelled to generational highs by the Federal Reserve's aggressive tightening cycle. Now, however, we are entering a new phase. As of today, the average 30-year fixed rate sits at 6.56%, a meaningful decline from the October 2022 peak of 7.08%. And well below the 2023 to 2024 average of 7.2 to 7.5%. On the surface, that may look like a minor shift, less than a single percentage point. But in the world of housing finance, such a move can be transformative. A mortgage isn't just about percentages. It's about monthly payments, debt-to-income ratios, and the psychological thresholds that determine whether buyers enter the market or sit on the sidelines. Why 6.56% matters. The psychological and practical threshold. Let's start with the practical math. Consider a median-priced U.S. home at around $430,000. With 20% down, that leaves a mortgage of $344,000. At 7.08%, the monthly principal and interest payment is approximately $2,295. At 6.56%, the same loan requires a payment of roughly $2,185. That $110 per month difference may not sound life-changing, but across 30 years it amounts to nearly $40,000 in total savings. More importantly, it brings many households back under key affordability ratios used by lenders. For first-time buyers working with tight margins, this can be the difference between an approved loan and a rejected application. There's also the psychological factor. Crossing below 6.6% feels closer to normal for many Americans, particularly those who remember rates in the 4 to 5% range just a few years ago. While we are unlikely to see such ultra-low rates return anytime soon, the current decline signals to buyers that the worst may be behind us. And psychology is critical in real estate. Once people believe the tide is turning, activity follows. First-time buyers, a window of opportunity. For first-time buyers, affordability has been the single greatest barrier to entry in recent years. High home prices, combined with elevated mortgage rates, pushed the typical monthly payment well beyond historical norms. In 2022 and 2023, the share of first-time buyers dropped to record lows, around 26%, compared to the long-term average of 38%. With rates easing, we are already seeing a modest rebound in mortgage applications, particularly among younger households. Millennials and even early members of Gen Z are re-entering the conversation. For many of these buyers, renting has become just as expensive, or even more costly, than purchasing, particularly in metropolitan areas with strong rental demand. But here's the key. While lower rates improve affordability, they don't solve the problem entirely. The median home price remains elevated, and in many markets, inventory is still tight. A rate of 6.56% doesn't suddenly make a $700,000 home in Los Angeles accessible to a young couple earning $80,000 a year. What it does, however, is open up suburban and secondary markets where price points are lower. Expect to see renewed activity in Sun Belt metros, Midwest cities, and smaller towns where entry-level housing stock still exists. Long-term investors, a signal to re-enter. The decline in mortgage rates also has profound implications for real estate investors, those who purchase not for primary residence, but for rental income or long-term appreciation. Over the past 2 years, many investors retreated from the market. Rising financing costs squeezed rental yields, while home price growth slowed, reducing the prospects for quick appreciation. At 7% or higher, even seasoned investors questioned the value proposition of leveraged property. But at 6.56%, the math looks different. Cash flow improves, cap rates become more attractive, and the risk-reward balance shifts back in favor of ownership. Investors with access to capital are likely to re-enter, targeting markets with strong demographic growth and rental demand. Think Austin, Nashville, Tampa, Raleigh, cities that combine affordability with economic momentum. Another point worth noting, not all investors rely on financing. Institutional buyers and high-net-worth individuals often purchase properties outright. For them, falling rates are less about affordability and more about market psychology. If individual buyers return, demand rises, and price appreciation follows. Thus, declining rates create a ripple effect that benefits all participants in the investment ecosystem. Historical context, a 5-year curve. To fully understand today's rate environment, it's helpful to look at the 5-year trajectory. Imagine a chart with the following points. 2020, mortgage rates hit record lows, around 2.65%, driven by the Fed's pandemic stimulus and low inflation. 2021, rates remained historically low, averaging 3%. Housing demand exploded, leading to bidding wars and unsustainable price growth. 2022, rates surged to 7.08%, the highest in 20 years, as the Fed battled inflation. Housing affordability collapsed almost overnight. 2023 to 2024, rates fluctuated between 6.8% and 7.5%, locking both buyers and sellers in place. Inventory dried up as existing homeowners refused to trade up or down. 2025. The current decline to 6.56% signals a potential turning point. Visually, this chart would show a dramatic V-shape, plummeting rates in 2020 to 2021, a sharp spike in 2022, and a gradual easing into 2025. For market watchers, the question is whether this curve stabilizes or continues downward. Can lower rates save the market? This brings us to the central question. Is a decline to 6.56% enough to rescue the U.S. housing market? The answer is complicated. On one hand, yes, lower rates unlock demand. They make homeownership feasible for more families, encourage investors, and restore confidence. We are already seeing early signs of increased mortgage applications and pending home sales. On the other hand, rates are only part of the equation. Housing affordability is a function of both financing costs and prices, and prices remain stubbornly high. In July 2025, the national median home price was $430,000, down only slightly from last year. In many coastal and tech-driven markets, the figure is closer to $800,000 or even $1 million. Without significant increases in supply, through new construction or existing homeowners choosing to sell, lower rates may simply reignite bidding wars, pushing prices higher and offsetting the benefit. In that sense, the cure could recreate the same imbalance we saw in 2021. Supply constraints and structural issues. It's also important to remember that America faces structural housing shortages. Estimates suggest the country is short by 3.5 to 4 million homes relative to household formation. That deficit cannot be solved by rates alone. Builders have ramped up activity in some markets, but construction costs remain elevated, labor shortages persist, and zoning restrictions limit supply in key cities. Even with financing more affordable, if the homes simply don't exist, buyers have nowhere to go. Thus, while rates are a powerful lever, they are not a silver bullet. They can improve conditions at the margin, but without addressing supply constraints, affordability challenges will linger. The risk of false hope. Another risk is that declining rates may create false hope. Buyers could rush back into the market expecting broad-based relief, only to find that prices remain stubborn. Investors might anticipate appreciation that never materializes. Policymakers may assume affordability has improved enough to ease pressure on housing reform, when in fact the underlying issues remain. History teaches us that markets respond to narratives as much as numbers. The narrative today is that rates are falling, the market is improving. That story can fuel short-term rebounds, but long-term sustainability requires deeper fixes. Looking ahead, what to watch? As we move forward, there are several indicators worth monitoring. Mortgage application data. Are buyers truly returning, or is the uptick a temporary blip? Inventory levels. Do lower rates motivate existing homeowners to sell, or do they continue to hold on to their sub-4% mortgages? Home price trends. Do lower rates trigger another round of price appreciation, undermining affordability gains? Construction activity. Are builders able to respond with new supply, particularly at entry-level price points? Federal Reserve policy. Will the Fed continue to ease, or will inflationary pressures force another tightening cycle? These factors will determine whether 6.56% is a temporary relief or the start of a durable recovery. Mini conclusion. A market in transition. In summary, the decline in the 30-year mortgage rate to 6.56% is unquestionably significant. It improves affordability, reopens the door for first-time buyers, and lures long-term investors back into the conversation. It shifts psychology from fear to cautious optimism. But it is not, in itself, a solution. Prices remain high, supply remains limited, and structural challenges persist. What we are witnessing is not a rescue, but a transition, one that could lead to stabilization if paired with increased inventory and sustainable pricing. For now, the message to buyers is this. Conditions are better than they were a year ago, but patience and strategy remain essential. For investors, opportunity is returning, but discipline is key. And for policymakers, the work of expanding housing supply is as urgent as ever. The housing market is turning a page, but the story is far from finished. Part 2. San Francisco's housing market. a surprising rebound amid Bay Area cooling. When we talk about real estate in California's Bay Area, the conversation often turns to decline. Over the past few years, the region has been marked by stories of falling rents, tech layoffs, population outflows, and commercial vacancies that left once bustling neighborhoods eerily quiet. Yet, amid that broader cooling, one city, San Francisco, appears to be charting its own course. Against expectations, the local housing market is showing early signs of a rebound. In 2025, San Francisco recorded a 5% increase in home sales transactions, rising from 2,870 to 3,010 units sold. At the same time, home prices edged slightly downward, slipping 1% year over year. For many markets, this would appear contradictory. How can sales rise while prices fall? But in San Francisco, it reflects a dynamic shift in both demand and sentiment, driven largely by the explosive growth of artificial intelligence, AI, as the city reclaims its role as a global hub for innovation. Underscore. The Bay Area in context, a cooling market. To understand why San Francisco's rebound is noteworthy, we first need to look at the broader Bay Area landscape. Over the past decade, the Bay Area was the epicenter of housing frenzy. Skyrocketing home values in Silicon Valley, Oakland, and surrounding counties were fueled by tech salaries, limited housing stock, and near-zero mortgage rates. From 2012 to 2020, home prices in the Bay Area nearly doubled. But beginning in 2022, the tide shifted. The combination of rising mortgage rates, tech industry layoffs, remote work adoption, and affordability challenges cooled demand across the region. Cities like San Jose, Oakland, and Fremont saw sales slow dramatically. Even desirable suburban areas like Palo Alto and Cupertino experienced declining transactions as buyers hesitated to commit at high prices with elevated financing costs. In many ways, the Bay Area became the poster child of America's housing correction, a market once too hot to touch, suddenly chilled by a cocktail of economic and demographic headwinds. And yet, within this cooling environment, San Francisco itself is beginning to diverge. Underscore. San Francisco's divergence. Sales up, prices down. San Francisco's housing story in 2025 is one of nuance. On one hand, transactions are rising. The city recorded 3,010 home sales in the latest 12-month period, up from 2,870 the year prior. That increase is modest, but in the context of regional stagnation, it represents meaningful momentum. On the other hand, prices have softened, dipping by roughly 1%. The median single-family home price in the city now hovers just under $1.45 million, compared to $1.47 million last year. Condos and multifamily units have experienced slightly larger declines, reflecting ongoing supply in downtown towers that cater to younger professionals. This combination, rising volume with modestly falling prices, signals that demand is improving, but buyers remain price-sensitive. Rather than sparking bidding wars, San Francisco is experiencing a more measured recovery. Homes are moving, but sellers are adjusting expectations to meet the market. The AI boom, a new catalyst for housing demand. The single most important driver of San Francisco's rebound is the artificial intelligence boom. Over the past 2 years, the city has become ground zero for AI innovation. Companies specializing in generative AI, machine learning, and robotics are not only headquartered here, but actively expanding. Venture capital funding is pouring into startups, while established giants like Google, Meta, and Microsoft are doubling down on AI research centers in and around the city. The result, a surge of high-paying jobs concentrated within San Francisco's urban core. Unlike the remote work wave that defined 2020 to 2022, AI firms are leaning heavily into in-person collaboration. The development of complex AI models requires teams of engineers, data scientists, ethicists, and hardware specialists working side by side. That preference for proximity has reignited demand for both office space and housing within city limits. For housing, the impact is immediate. Young professionals entering the AI sector are seeking condos and apartments near their workplaces. Established engineers and executives are purchasing single-family homes in neighborhoods like No Valley, Bernal Heights, and Pacific Heights. Demand is further supported by international talent relocating to the Bay Area as companies recruit aggressively from Europe and Asia. Underscore. The rental market, rising again. The clearest evidence of AI's influence can be seen in San Francisco's rental market. After years of weakness, rents are climbing again. In 2023, the city's median rent for a one-bedroom apartment had dropped nearly 20% from pre-pandemic highs. By mid-2025, those losses have been largely erased. Median rents are now up 8% year-over-year, driven by demand from tech workers returning to the city. Landlords who once struggled with vacancy are finding strong interest again. Downtown high-rises that languished during the remote work era are seeing occupancy rates improve, while smaller units in trendy neighborhoods are commanding premium pricing. For many investors, this rental rebound provides the confidence to re-enter the market, purchasing condos and multifamily properties with expectations of steady cash flow. Underscore. Challenges still loom: affordability and flight. Despite the positive momentum, San Francisco's rebound is not without challenges. Affordability. Even with modest price declines, the city remains among the most expensive housing markets in the United States. A median home price of $1.45 million requires a household income far above the national median, even at today's slightly lower mortgage rates. This limits the pool of potential buyers to high-income professionals and investors. Population outflow. The broader trend of Californians leaving for states like Texas, Arizona, and Nevada has not reversed. Many families continue to seek lower costs of living and better housing value elsewhere. This means San Francisco's rebound is likely to remain concentrated in the upper tiers of the market rather than across all demographics. Commercial real estate weakness. While AI firms are leasing office space, large swaths of the downtown core remain underutilized. The conversion of office towers into residential units could eventually support housing supply, but such projects face regulatory and financial hurdles. These factors suggest that while AI has reignited demand, the city still faces structural constraints that could cap the pace of recovery. Is this a sustainable recovery? The critical question is whether San Francisco's rebound represents a temporary surge or the beginning of a sustainable turnaround. On the optimistic side, the AI boom is not a short-lived trend. With billions in venture capital investment and federal attention on AI competitiveness, the industry is likely to grow for the next decade. That growth will continue to funnel jobs, and by extension, housing demand, into San Francisco. Rising rents make investment properties more attractive, drawing capital back into the city. Increased transaction volume, even at lower prices, suggests that liquidity is improving. A functioning market, where buyers and sellers are engaging, is healthier than the frozen standoff seen in many other cities. On the cautious side, affordability remains a severe issue. Without broader solutions to housing supply, the market could once again overheat, pricing out all but the wealthiest. San Francisco's reliance on a single industry, technology, makes it vulnerable to shocks. A downturn in AI or a shift in corporate strategies could quickly reverse momentum. Broader Bay Area weakness means San Francisco is not insulated. Regional headwinds could spill into the city if job growth slows. Underscore. Looking forward, what to watch? To gauge whether San Francisco's recovery is sustainable, here are key indicators to monitor. 1. Home sales volume. Does the 5% increase continue, or was it a short-term surge? 2. Price trends. Does the 1% decline stabilize, or do prices fall further before bottoming out? 3. Rental market growth. Are rising rents a lasting trend, or will supply adjustments cool the market again? 4. Job creation and AI. As long as the city remains the center of AI innovation, housing demand should remain strong. 5. Policy and development. Will the city address housing shortages through zoning reform and streamlined construction approvals? Underscore. Mini conclusion. A market rewriting its story. San Francisco's housing market is rewriting its narrative. After years of being cast as a cautionary tale, plagued by high costs, crime headlines, and outmigration, the city is emerging as a case study in resilience. Sales are up, prices are stable to slightly lower, and rents are climbing again. At the center of it all is the AI industry, breathing new life into a city that many had written off. Is this the start of a long-term resurgence? The data suggests cautious optimism. San Francisco is unlikely to return to the breakneck growth of the 2010s, but it is equally unlikely to fade into irrelevance. Instead, we may be witnessing the birth of a new cycle, slower, more balanced, but firmly anchored by innovation. For buyers, this is both a challenge and an opportunity. For investors, it's a moment to consider whether San Francisco, long dismissed as too expensive or too volatile, may once again belong on the short list of America's most compelling real estate markets. Part 3. Miami, the luxury market. When we talk about the most glamorous, headline-grabbing housing markets in the United States, few cities can rival Miami. For decades, Miami has embodied the dream of oceanfront luxury, global appeal, and the allure of the good life. But in recent years, Miami's real estate market has not only thrived, it has evolved into one of the premier destinations for ultra-high-net-worth individuals, celebrities, and international investors seeking both trophy properties and safe havens for their wealth. Today, Miami's luxury housing market is in a league of its own. The numbers tell the story. More than 53.5% of homes priced between $1 million and $5 million are purchased entirely in cash. That alone would be extraordinary compared to most U.S. cities, but Miami takes it even further. In the superprime category, homes valued at $10 million or more, nearly 59% of transactions are all-cash deals. This heavy reliance on cash doesn't just signal deep-pocketed buyers. It underscores the fact that Miami has become a truly global capital of wealth, one where credit cycles and interest rate fluctuations, at least on the surface, play a less direct role in driving the high end of the market. Instead, it's a market powered by liquidity, lifestyle, and global prestige. Who's buying in Miami? The profile of Miami's buyers reveals just how international and elite this market has become. The ultra-wealthy elite. Miami attracts billionaires and centimillionaires from across the Americas, Europe, and increasingly, the Middle East and Asia. These buyers are not typically financing their purchases. They are deploying cash as a way to secure a slice of Miami's skyline or its coveted waterfront estates. Celebrities and athletes. From international music icons to NBA stars, Miami has become the playground of the famous. The city offers not only privacy and luxury, but also a vibrant cultural scene and nightlife that appeals to high-profile personalities. Foreign investors. For Latin American investors, Miami has long been the financial and cultural capital of the region. Venezuelan, Brazilian, Colombian, and Argentine buyers see Miami real estate not just as an investment, but as a hedge against political and economic instability back home. More recently, buyers from Canada and Europe have also joined in, drawn by Florida's tax advantages and warm climate. Together, this mix of buyers creates a demand dynamic that is unique. Miami's luxury market is less tied to local wages or domestic mortgage markets, and more dependent on global wealth flows. The reality check. Challenges beneath the glamour. Yet, beneath the glittering headlines and multi-million-dollar closings, there are signs that Miami's luxury real estate machine is cooling, at least slightly. The most telling statistic is the average time on market. According to recent data, luxury homes in Miami are taking an average of 96.5 days to sell, the highest among the top 20 housing markets in the U.S. That's a striking contrast to the frenzy of the pandemic years, when properties were snapped up in a matter of days, often sight unseen. Why does this matter? Because time on market is often one of the first indicators of changing buyer sentiment. If buyers are becoming more cautious, taking more time to negotiate, or walking away from overpriced listings, it suggests that the once red-hot Miami market may be encountering headwinds. What's driving the slowdown? Several factors explain why Miami's luxury segment is taking longer to move inventory, even while attracting cash-rich buyers. 1. Higher price expectations from sellers. Many sellers in Miami became accustomed to the breakneck appreciation of 2020 to 2022, when homes could sell 20 to 30% above asking. Today, while demand is still strong, buyers are no longer willing to pay just any price. Sellers who cling to peak valuations are finding that their properties linger on the market. 2. Global economic uncertainty. Miami's dependence on international wealth is both its strength and its vulnerability. With economic slowdowns in Europe, political instability in Latin America, and fluctuating currencies worldwide, some foreign buyers are holding back or being more selective. Even the ultra-rich are not immune to the broader uncertainties of global markets. 3. Interest rates and the broader U.S. economy. While many Miami transactions are cash-based, the overall financial climate still matters. Higher U.S. interest rates affect liquidity and portfolio valuations for wealthy investors. If equities soften or credit tightens, discretionary purchases like a $15 million Miami penthouse may take longer to justify. 4. Luxury inventory expansion. Developers have seized on Miami's boom, leading to an unprecedented wave of luxury condo towers, branded residences, and waterfront estates. While this supply reflects strong demand, it also means buyers have more options, leading to longer decision cycles and tougher competition among sellers. Miami's unique advantages. Despite these challenges, it's important to stress that Miami's luxury appeal is not fading. It is simply maturing. Miami possesses structural advantages that keep it on the global radar. Climate and lifestyle. The combination of year-round sunshine, beaches, and cultural vibrancy makes Miami one of the most desirable places to live. Unlike purely financial hubs like New York or London, Miami offers both luxury and leisure. Tax benefits. Florida's lack of a state income tax continues to attract wealthy individuals, especially those fleeing high-tax states such as California, New York, or Illinois. Global connectivity. Miami's international airport is one of the busiest gateways to Latin America and Europe, reinforcing its status as a global crossroads. Prestige developments. Branded residences, such as those affiliated with luxury names like Armani, Porsche, and Ritz-Carlton, elevate Miami's profile and attract buyers seeking more than just square footage. In short, Miami has built an identity that transcends the ups and downs of cyclical housing markets. The key question: can Miami sustain its allure? The real question for investors and observers alike is this: can Miami's luxury market sustain its momentum in the face of rising interest rates and global economic turbulence? The answer lies in recognizing Miami's dual identity. On one hand, it is a U.S. city subject to the same macroeconomic forces as the rest of the housing market. On the other hand, it is a global luxury brand in itself, one that sells lifestyle and prestige as much as it sells real estate. If the global wealthy continue to see Miami as a safe harbor for capital, the city's high-end segment will remain resilient. Even if transaction volume slows and days on market extend, prices may remain elevated because sellers are in no rush to liquidate trophy assets. For many buyers, these homes are not speculative plays. They are long-term lifestyle choices and wealth preservation strategies. However, if global liquidity tightens dramatically, whether through equity market downturns, currency crises, or rising political risks abroad, Miami could face a sharper adjustment. In such a scenario, the abundance of new luxury supply could weigh on prices. A market of contrasts. Ultimately, Miami's real estate story is one of contrasts. Cash abundance versus slowing sales cycles. A global demand versus local affordability concerns. Record-breaking luxury towers versus growing inventory risks. For analysts, investors, and even policymakers, Miami serves as a fascinating case study in how a city can become both a beneficiary and a hostage of global wealth flows. The luxury segment is thriving, but beneath the surface, it is evolving from a breakneck boom into a more discerning, cautious marketplace. Conclusion: Miami's luxury housing market is dazzling, complex, and globally significant. It's a market that doesn't just reflect local dynamics, but the currents of international finance, migration, and culture. With over $500,000 homes bought in cash and nearly 60% of $10 million-plus estates closed without financing, Miami's high-end segment defies traditional market rules. Yet, the 96.5-day average time on market is a reminder that even the most glamorous markets face limits. Buyers are becoming more selective, economic clouds are forming, and supply is abundant. Still, Miami's allure, its lifestyle, tax benefits, and global brand, remains unmatched. The city has established itself not just as a U.S. destination, but as one of the world's premier luxury markets. The next chapter in Miami's story will hinge on whether it can balance its irresistible appeal with the realities of a more cautious, globally interconnected economy. And for now, the world is still watching Miami, not just for its sunshine and beaches, but for what its real estate tells us about the flows of wealth and the future of luxury living. As we wrap up this analysis of the U.S. housing market, it's clear that 2025 is shaping up to be a year defined by contrasts, opportunities, and challenges across different regions and market segments. The real estate landscape is no longer moving in unison. Instead, it has become a mosaic where each city tells its own unique story. One of the most important macro-level forces at play is interest rates. After several years of elevated borrowing costs, the Federal Reserve's recent signals toward easing monetary policy have opened the door for new opportunities, especially in the mainstream housing market. For everyday buyers, the prospect of lower mortgage rates means improved affordability, which could breathe new life into suburban and mid-tier urban housing. These are the types of homes that families, young professionals, and first-time buyers are watching closely. When financing becomes more accessible, demand has a way of accelerating quickly. This shift could spark a rebound in sales activity, particularly in markets that have seen pin-up demand sitting on the sidelines. At the same time, regional dynamics remain critical. San Francisco, a city often labeled as the canary in the coal mine for both booms and busts, offers a fascinating glimpse into resilience. Despite years of downturn and outmigration concerns, the Bay Area is showing signs of stabilization. Tech, as always, plays the leading role, with advancements in AI, cloud computing, and biotech fueling renewed investor interest. The local housing market is slowly regaining momentum. What we are witnessing is not a full-blown recovery just yet, but the seeds of one, proof that innovation-driven economies can re-energize real estate demand when fundamentals align. Meanwhile, Miami stands in a league of its own. Unlike most American cities, its market is less tethered to interest rate cycles because a striking share of purchases are made in cash. Over half of homes priced between $1 and $5 million were bought outright, and nearly 59% of ultra-luxury homes above $10 million also closed without financing. Miami has positioned itself as the ultimate playground for the global elite, celebrities, international investors, and ultra-high-net-worth individuals. The skyline dotted with luxury high-rises and oceanfront estates reflects a demand profile that's unlike anywhere else in the country. Still, the challenge is clear. Selling times are getting longer, averaging over 96 days, by far the highest in the top 20 U.S. markets. This could be an early signal of overextension or simply a recalibration in a segment that thrives on exclusivity. So, where does that leave us when we look at the bigger picture? The U.S. housing market is no longer a single narrative. It's a story of segmentation. Affordable housing opportunities are likely to open up as rates come down. Innovation-driven hubs like San Francisco may stage a comeback, and luxury-dominated enclaves like Miami will continue to serve as magnets for global wealth, even if momentum occasionally cools. In the short term, expect continued polarization. The trajectory of the market will depend heavily on local economies, buyer demographics, and the broader direction of global capital flows. There is no one-size-fits-all answer. Instead, investors, homeowners, and observers will need to look city by city, segment by segment, to identify real opportunities. And now, I'd like to turn the conversation over to you. Given everything we've explored today, from interest rate shifts to San Francisco's resilience to Miami's luxury dominance, what do you think is the most attractive destination for real estate investment right now? Is it the mainstream suburban market that could rebound first, the tech-fueled Bay Area, or the global luxury stage of Miami? Share your thoughts in the comments below. I'd love to hear your perspective.